Welcome to Price Cues. Today we're going to see the difference between trading and investing. Welcome back, I'm Sharyu. Before we move on, please do not forget to follow us on Instagram and Facebook, and do subscribe to the channel and hit the notification bell so that you don't miss another update from us. Now, let's get started. Let's start by understanding the basic meaning of investing and trading. Investing is basically holding a stock for long-term benefits. It is the act of allocating resources, usually money, with the expectation of some kind of income or profit. Investments are not limited to stock market. Using your money to start a business or buy an asset or purchase real estate all comes under investing. So overall, investing is just allocating your resources, which in this case is money, into some kind of asset to gain long-term benefits, while trading is simply the buying and selling of a stock to achieve a defined target. With the help of technical analysis and historical data, trading is buying or shorting a stock and holding it till the defined target is achieved. Just like the old school meaning of the word trade, where an exchange of goods used to take place, similarly in the stock market, buying and selling of stock takes place to achieve a target to earn profits. Now, let's understand the basics of investing and trading. Let's start with investing. Investing is based on fundamental analysis. Fundamental analysis is the analysis of a business's financial statements. The cash flow statements, income statements, balance sheet analysis, the management of the company, its competitors, and other factors come under fundamental analysis. Since investing is done for the long-term view, fundamental analysis plays an important role in this. Investments are made with a long-term view ranging from 6 months to 10 years. Investments can be made for short-term, for 6 months to a year, and can also go as long as a decade or even more than that. This completely differs from investor to investor. Now, let's move on to trading. Trading is completely based on technical analysis. Technical analysis is examining the fluctuations in the price based on previous data. Technical analysis includes previous data of the price fluctuations in the form of charts. It purely focuses on price, and it helps in examining and predicting the price movement in the market. Trading is normally short-term, ranging from a couple of minutes, an entire day, or even a week. And sometimes, even in a couple of seconds, the trade can be done. This completely depends on the type of trader. So, to just get a brief idea, investing is based on fundamental analysis and has a long-term view, while trading is based on technical analysis and has a short-term view. Now let's go even in more detail about each of them. Let's understand about investing first. The goals of investing is basically focusing on long-term gains. An investor does his fundamental analysis and believes in the company's growth. He invests in the company with a view to gain long-term profits. Now, there are the short-term investors and the long-term investors. The short-term investors are investors that invest their money in the stock market for a time period of 6 months to a year, while the long-term investors invest their money for a year, up to 5 years, or even more. Sometimes investors keep their investments even more than a decade. Intrinsic value is the price an investor is willing to pay for an investment given its level of risk. For example, if you being an investor have selected a stock, done your fundamental analysis, and are planning to invest, will actually look at its intrinsic value. The intrinsic value will explain how much risk you have in this particular investment. A point to note is that intrinsic value is different from the price of the stock. The price of the stock keeps fluctuating because of the buying and selling that happens in the market, while the intrinsic value is the inherent value of the stock, which depends completely on how good the company is. To better understand intrinsic value, sometimes due to panic, a good company's stock can start falling. But even though the company's stock has fallen to a lower price, the value of the company does not reduce as the company is really strong. So even though the market drops, the intrinsic value still remains intact as the value of the company is still strong. So a company that has a good intrinsic value is a good stock to invest in. Moving on to utilization of capitals. As investments are made for long term, they don't get the benefit of leverage. Leverage is the borrowed capital used to increase the potential returns of an investment. In simple words, when you sign up with a broking firm, the broking firm allows you some percentage of leverage whereon you can take up a trade which is 10 to 15 times more than your capital and gain the profits. But since investments are for long term, you don't get the benefit of leverage. So you have to use your entire capital. If you're still confused about the concept of leverage, it is explained in more detail in the video ahead. Placing orders. An investor doesn't have to place a lot of orders. As his goal is long term, he will buy the stock and leave it for the time period decided. In investing, one cannot short sell the market. You can only place buy orders. That's the reason most of the investors use the buy on dips strategy. Once the market starts falling, the investor starts investing small chunks of money into the market. Now, let's understand trading. The goals of trading are very simple. They focus on short-term and quicker profits based on technical analysis. Technical analysis means examining and predicting the market price based on historical, price charts and market statistics. In this case, the trader uses specific technical strategies to attain specified targets. If you want to know more about technical analysis strategies, check out my other video by clicking on the I button or the link in the description about how to select the ideal trading strategy to get consistent profits. Now, let's see the type of traders. Traders can be of many types. The intraday traders are traders that trade the entire day active during the market hours. They do not carry forward their position for the next day. Once they've taken a position in the market, they make sure they square off the position before the market hours end. Swing traders. Swing traders are traders that try to capture the entire swing of the market. These traders continue their trade for as long as their swing continues. A dedicated video about swing trading strategies is coming soon, so stay tuned. Scalpers are the quickest traders. They execute the trade within minutes and sometimes even within seconds. They trade in huge quantities and are concerned with very small profits. The scalpers trade for 1 or 2 candles at the most. Positional traders are traders that hold their positions until their target is achieved for more than 1 day. Positional traders are basically trend-following traders where they only square off their position when the trend is about to reverse. Sometimes positional traders even carry their positions for more than a week or so. Trading is based on price action. It does not consider the intrinsic value. A trader who buys a stock today can short sell the stock tomorrow with no hesitance if the market gives him the signal. A trader is only concerned with the fluctuations in price and the number of buyers and sellers that are available in the market. Most of the traders sometimes trade a stock without even knowing what the company actually does. Even without knowing about the company, the traders still trade in the stock and gain profits. So even if the market is falling, the trader can still earn by short selling the market. So in short, traders get both the opportunities to buy as well as sell to gain profits. As we discussed earlier about leverage, traders get the benefit of leverage. You can get up to 15 times leverage depending on the stockbroker you select for intraday, which means that you can start with a small account too. For example, if you have 10,000 rupees and are trying to invest in the market, and let's say the stock that you're trying to trade in is for 1,000 rupees, without the leverage you can only buy 10 stocks. But with 15 times leverage, you get a total amount of 1,50,000 to trade instead of the original 10,000. Leverage has its own benefits and drawbacks, but if we see the benefits, a trader, in spite of having a small account, using the leverage can generate good profits. As we discussed earlier, in investing you can only place buy orders, but in trading you can place buy orders as well as sell orders, and that too as many times as you want, depending on the market condition. I hope you've understood the basic difference between trading and investing. That's it for today's video. Please do not forget to like, comment, share and subscribe and hit the notification bell so that you don't miss another update from us. Thanks for watching. Stay tuned for more. See you next time. Bye.